You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
I'm honored to introduce the next panel, Demystifying ETF Option Trends. We've all witnessed the proliferation of ETFs in recent years, both in the number of new products and the inflows of capital. There are entire conferences dedicated to this investment vehicle, but rarely does the discussion center on options and have two of the largest ETF issuers and two of the largest option market makers sharing the stage together. Today we're fortunate to have both, along with an expert moderator and, from what I understand, scratch golfer, Steve O, who's the head of ETF listings and business development at Nasdaq. So over the next 45 minutes, Steve will lead our panelists on a discussion about what is driving the current trends in client ETF option usage and suggestions for how to improve the issuer, market maker, and ultimately investor experience. So please join me in welcoming Steve and our panelists to the stage.
Thanks very much, Mike. Well, oh good, this mic works. I was a little bit nervous about that. Thank you everyone for coming this morning. It's really great to see the turnout, the support. Wanted to first thank you all, thank the organizers, the OIC, OCC, the exchanges for being here. And Mike put a lot of pressure on me now on the golf course, now that he's called me out for being a scratch golfer. So I'll try to put your attention onto ETFs and, I want to be known as the ETF person and not the scratch golfer. So, just a little bit over there. So, as Mike had said, my name is Steve O. I'm the head of ETF listings and business development at Nasdaq. And I'll let the panelists introduce themselves, starting from Stacey.
Great. Good morning, everyone. I want to say thank you to the OCC and Nasdaq as well. My name is Stacey Gilbert. I currently run our derivative strategy team for the institutional sell side of Susquehanna International Group.
Hi. My name is Lawrence Tanzman. Everybody calls me LT. I also want to thank Nasdaq for hosting this fantastic event. It's my first OIC, so it's been great to be welcomed here to this community. And I run the options routing for Citadel Execution Services market maker.
And I'm James Maund. I work with the State Street Spider ETFs on the capital markets team. I focus specifically on our institutional clients, and just honored to be up here with such a great panel.
And I'm Grayson, Lipton, and I head up liquidity and execution services for Invesco PowerShares. That is a capital markets function as well. In that capacity, I act as a liaison between buy side and sell side as clients look to execute into and out of our products. On the options side, we have a weekly options report that we put out to the street just regarding trends in the ETF options arena.
So you may not be familiar with the panel structure here, but it's a little bit different where the moderator is not sitting on one of the ends. I'm actually sitting in the middle for a very big reason. So on my left side are the ETF options market makers, and to my right side are the ETF issuers. They both play an integral role. They're both my clients. One issues the funds, and the other provides liquidity and distribution for users. In case things get a little bit contentious during this panel, I've got to play Jerry Springer and make sure that I intercede, and make sure no one gets hurt here. So, there could be some fireworks. I'll make sure it doesn't happen. So on that note, I'll start off by pointing to the charts on the screen around some data. The data really very simply just shows the increasing presence and usage of ETF options. Just 11, 12 years ago, ETF options traded less than 500,000 contracts. And that growth in the last 10 years has been phenomenal. It's grown to close to 2 million. I'm proud to say that ETF options are on their way to a record year, having traded over 500 million. Sorry, it's like one of my Austin Powers moments right here. Options volume has hit over 500 million contracts. We're on to a record year and hopefully looking to hit the 2 billion mark. So we're excited for the start of ETF options, and we'd like that trend to continue. And for the people that are visual, just wanted to show that the trend lines, the blue line representing equity option volume, doing very well, has had a great Q1 so far. But the orange line, which represents ETF options trading, shows the very quick growth trend that's happening in the ETF options space. So after that data, I'd like to kind of have just look into why that's occurring. Why is that dynamic of increasing ETF options occurring? So I'd like to start off by maybe having Stacey give her perspective.
Sure. So I just have to kind of joke. Before I took the stage here, 2 things were told to me. 1, to talk slowly, and 2, to not trip. I didn't trip, so I'm excited about that. The talking slowly, I cannot promise, having grown up on an exchange, and not swearing, I certainly cannot promise. So if it slips out, just realize it's an adjective to me at this point, and I'm not even aware. Growth of ETFs. So what's fascinating if we think about the growth of ETFs, as Steve's slide showed there, all of the growth over the last decade has been within the ETF industry. It's up 500% versus some of your equities, which are up about 25%. Yes, options have grown. ETFs are certainly the area where it's growing the most. What's interesting is where that growth has been. So if you think about 10 years ago, what were the products that we knew? We knew the Qs, we knew the SPYs, we knew IWM, and that was really the concentration. Where are some of the most active products right now? It's going to be things like emerging markets, HYG, your volatility products. These didn't exist 10 years ago. So I think a lot of the growth is there are certain asset classes that we didn't have access to 10 years ago that we now have access to. There are ways to hedge out certain aspects of your risk to your portfolio that weren't there before. So I think that's tremendously helped with the growth, is not just the growth of the ETFs, the actual types of ETFs that have come about. Think about the fixed income market in particular. HYG, where was the easiest way to hedge out some of your high yield credit before? It was all an OTC type of market. And now you have a product that allows you to hedge it out on a listed product, something that you can see the prices, something that's much more transparent. So I think the shift from wanting the transparency on a listed market and now having access to it has been a tremendous help for the growth within the ETF space, particularly the ETF option space.
LT, any comments on from your end?
Echoing a lot of the similar comments that Stacey made, or the additional ETFs we have now are also allowing clients to have much more sophisticated strategies in general, both in the products that are offered and in the usage of complex strategies that have really grown over the past 10 years, and we're seeing increased sophistication in how our clients are using them, how they're asking for markets there, and that's been really exciting to see, because that's a great growth area for the industry overall, and for what we try to offer as an electronic market maker.
Okay, great, thank you. And maybe some perspectives from the ETF issuer side, starting from James?
Sure. I think it's in kind of 2 areas. One is certainly the new products coming to market and gaining momentum. Things like fixed income ETFs are certainly a big driver of growth for our industry and have been for the last few years. But we even look at asset classes that no one would have ever imagined being investable in an ETF wrapper or available to kind of every investor. Things like bank loans, which I know have gained a lot of momentum recently with the expected rise in interest rates. But the other thing that's really amazing to me is still have we just scratched the surface with certain investor types, and there are new users coming into the ETF market all the time. There are a lot of very sophisticated investors that I speak to, large pension funds, endowments, insurance companies, who are very sophisticated investors, but not necessarily big users of ETFs yet. And that's certainly something that I think we're all thinking about when we look forward to the growth in the industry and the growth of assets and ETFs. Those types of clients, when they really start to get involved, we think there'll be an even greater tailwind to our industry and certainly the options trading on them as well.
Thanks, James. And Grayson, would you like to add something?
Yeah, if you think about the infancy of the ETF structure, essentially at the beginning, when there wasn't a lot of AUM, products like SPY and QQQ were the most optionable. They were index arbitrage type products. But as time progressed and more ETFs came into being, we saw ETFs with derivative instruments tied to them garnering more options open interest as well. FX type ETFs like FXE and UUP, and then futures type products like USO and DBO garnered interest. And now what we're seeing is more on the fixed income side. We're seeing HYG and JNK take a lion's share of the ETF options space, but other fixed income instruments are definitely starting to garner some interest as well. Preferreds and, as James mentioned, bank loan.
Okay, thank you. And maybe trying to expand on this topic of what's been driving the growth. Any thoughts maybe you can add on to what might be what will drive the growth even further into the future as well?
Yeah, I think that we're going to continue to see the trend of fixed income ETFs garnering more options open interest, but also, if you think about it, the buy side has a lot of an ability to push the envelope when it comes to ETF options. And you're looking at the team up here that you'd reach out to as a buy-side participant. If you want open interest in a particular option, if you want to drive flow into a particular option, you're going to want the issuers and the market makers to price out those options. Once you have a position established, it'll manifest itself in on-screen liquidity. But until then, we just are driven to where the interest is, and that's driven by the buy side.
And James, what about your perspective in State Streets?
Yeah, I think primarily as a risk mitigation tool. Certainly, given the market environment we're in, and the fact that we're probably, in a lot of people's opinion, at or approaching a top in the market. A lot of the conversations we're having are centering around risk mitigation, and certainly during market shock situations like August 24th of 2015, we saw kind of the negative fallout of a lot of stop loss orders and kind of traditional stock trading techniques that are supposed to mitigate risk. But in reality, I think kind of the tide went out and we got to see what was really there, and those strategies were pretty ineffective in terms of mitigating risk. And consistently in those conversations in the aftermath of August 24th, the conversation would go toward options. That was really the only way for clients to have kind of a guaranteed risk limitation in their portfolio. So those conversations continue to go on. But also we see a lot of ETF users looking at specific sector and industry exposures, and again, a big uptake in the options on the sector and industry funds as well. So, it's really across the board, but I think that risk mitigation conversation is the hook that gets most of our clients really interested in options.
Got it. And then from the market maker side, any insights into what you're preparing for as you kind of see the upcoming trends in ETF options usage?
Sure. So, there's a couple interesting things going on in that with rising interest rates for the first time in many years, that has driven a lot of interest towards the fixed income products, as Grayson was saying. And that's going to be a really interesting trend for us to watch, both in terms of the products that focuses on and actually how we price those options and manage our risk around our interest rate exposure. So that's been a really interesting trend, also in the context of the capital discussions we've been having throughout this week already in terms of what that means for our ability to expand liquidity provision.
Stacey?
Yeah, I would add that I do think fixed income is the biggest area of growth. This is just, it's a very opaque market. This is a market that you want better transparency. So I do think that there's a desire to see more products, both probably on the ETF side and then obviously the options on the ETF side. One of the things that I think is interesting that has the potential to really see growth as well is if we think about treasuries. For the most part, we can argue that if you want to hedge a treasury portfolio, the options on the Treasury are incredibly liquid, right? For the most part, do you need to hedge with ETF options? Well, as you start going out further in time, you do. There's just more expirations as you're looking at some of these ETFs. So you do get exposures that you can't get in other incredibly liquid products. And I think that's areas where, as market makers, we can certainly focus, where I think there is opportunity there as investors are looking for longer term types of hedges in products that it just doesn't have the equivalent in a very listed, very liquid market.
Thank you, NLT and Stacey. So I wanted to give you a deeper insight into what is going on with ETFs options trading. Many of you know already, but just wanted to dig deeper into the data itself. So the one thing that this chart is showing is that even though ETF options have grown, they've grown in a handful of products that dominate the trading. And so you have names like SPY, Qs, IWM, EEM, and VXX that are very active, but it falls off very quickly, even within the top 25 names in terms of activity. As you go further down the list, it gets much smaller. This is once you get to the 100th ranked ETF option by trading activity, you'll see that the contracts that traded in Q1 of 2018 fall off significantly. And what I wanted to do is also point to the right column for AUM, or assets under management, to show that some of these are very large funds. You have names like VGK, MDY, which represent Europe and mid-cap, that we all know they have almost $20 billion in assets under management, a lot of ETF volume trading on a daily basis, but the options are not being used. And so a big part of why we wanted to have this panel was also to discuss what's driving this and what can we do to improve the space for the less active ETF options. So to get that conversation started, I would like to start off with Grayson and see what his perspectives are on why the activity is concentrated on only a few ETF options.
Yeah, as I look at that list, it's dominated by the index arbitrage type vehicles. And at the end of the day, liquidity begets liquidity. If you have more individuals in a particular space, that's going to drive the flows into that space as well. So, from that perspective, that's really the reason I think that we're seeing dominance in a select few ETFs.
And I think it also comes down to, to the user type in each of those funds. As I looked at that list, certainly, SPY is kind of an outlier. It has, every type of investors involved with SPY one way or another. But the key piece of that investor community that's active there is also obviously very knowledgeable on options, comfortable with using options. I looked at other funds on that list like XLF. Again, very sophisticated user type, and there's still a big gap in terms of education that I think we're all well aware of. We have this certainly in the ETF space alone, but certainly exists in the option space as well, where once we get more investors comfortable with using options around their ETF positions, I think we're going to see volumes and open interest in some of those other funds really take off. But certainly the top names on that list are just primarily names that very sophisticated investors are using as hedging vehicles one way or another.
Stacey, maybe from the market maker side, some perspectives?
Yeah, I think there are a lot of factors going into this. One, we're pulling data from, this was the first quarter, right? If you were to pull data around 2016 Brexit, the list would have been different. Right, there are various periods in time where options in one particular, whether it be a sector or really some of these country products, really takes off. So EWW, it's Mexico. For the most part, it very rarely traded. It traded around 2,500 contracts on average. As you got to the U.S. election, there were days it was trading 100,000 contracts. So they can pick up if there is interest around bigger events. So I don't want to say that list has to remain where that list is always. On that list, what we didn't see, GLD's on there. GLD's not one of your top 25 in terms of how much the actual underlying trades, but the options, just as an alternative to the gold market, it's there and it does trade. So there can be various ETFs that are going to come in and out as just the environment is changing. A couple other things I would highlight, though, is, so SPY is obviously top on there. Think about the amount of money that follows large cap. So fine, maybe you have an ETF that is a large cap ETF that you think has the better portfolio construction that you want. makes perfect sense to potentially own that ETF. But when things happen, what happens to this market? Correlation goes to 1. So a SPY hedge is probably going to do just as well as whatever that ETF hedge is. If you're really looking at some of these crash scenarios, there is some idiosyncratic risk for some of these smaller moves, but true crashes, it's very similar. So you're looking at a product that already has a ton of liquidity, you do a back test, you're doing this analysis, and you say, okay, SPY's going to hold up just as well, and I know I can get a lot more options in SPY, so I'm just going to use SPY. So I do think that's one of the reasons the concentration continues to be there. Ways that I think it can change, though, is as more and more funds continue to want to be income generators, the overriding aspect of ETFs, there are reasons to use that specific ETF to overwrite. And to everybody on the panel's point here, volume begets volume. So that is one of the ways that this can help grow that list to have more concentration in just other than those top 5 there.
And so echoing some of that, liquidity begets liquidity. And that's something that we definitely see the same thing there, and that's driven a lot of the growth in SPY in particular. And we're really thrilled with the growth we've seen there, but we say, okay, well, where can we grow the industry more? How can we build on the success we've had in some of those top products to grow overall volumes as we go down the list? And one of the big things that we look at it as a market maker is that those bid-ask spreads widen out substantially as you start to go down the liquidity spectrum. And that's a really big concern to us. And we've seen some interesting data earlier this week on that phenomenon. So that's, when we think about market structure, we're looking at those ETFs and saying the bid-ask spreads are wide. We want investors to be able to look at these options and know that there's going to be liquidity that's accessible for them to both get in and out of these positions as news comes around and as different macro events start to occur. And so we're looking at a lot of different market structure issues like the price improvement auctions that we've talked about earlier in this conference that we're worried are inhibiting our ability to quote tightly and consistently in all of these options as you go down the liquidity spectrum.
Steve, if I could just add one more point. The one thing I would also keep in mind is it's not that much different on the single stock side. You have about 3,000 stocks that have listed options, and maybe 4% of those trade 10,000 contracts or more. So a name like Rockwell Collins, it's a name that everybody knows. It's a $100 billion company, and it trades less than 100 contracts a day. So it's not specific to the ETF space. Admittedly, if we're looking at 10,000 names that trade about 10,000 option contracts a day, you're looking at maybe 40 out of the 2,000 options. And there's less that actually trade ETFs, maybe 600, 700 actually have options listed on them. So on a percentage basis, it's not that much different than stocks. And if you think about stocks, those are specific to one thing versus the number of lookalike products that ETFs have. We are double counting a lot here when we say the S&P 500, and you can look at VU, IVV, SPY. They're all very similar products, so you can choose one. Versus the stocks, these are all very different companies. So concentration isn't specific to just ETFs.
Okay. On the notion of displayed liquidity, bid-ask spreads that are on screen, I wanted to pose a question for the issuer side. And as you're having conversations with your clients potentially around ETF options, what impact does that displayed liquidity bid-ask spread have? And as we know, and I think all the experts here do know, that you can get better liquidity by, let's say, proper order handling. But still, what challenges does the ETF issuer community face with those displayed quotes?
Sure. Well, I'll just begin by saying that it's a very similar issue to what we see with some newer ETFs and ETFs with lower average daily trading volume, where there is underlying liquidity, and given the right trading strategies, approaching the market in the right way, there is more liquidity than meets the eye simply in terms of the on-screen markets. So it's a conversation that we're very comfortable having and have been having for years. But it still is an impediment. We see it even in ETFs. We're the beneficiary of having some ETFs that have very large trading volume, far and away the most liquid in the market. And we have a lot of clients who we've never spoken to who use our products simply for that reason, and they don't really look at any of the other aspects of the fund, the specific exposure it provides in any real detail, or any of the other kind of elements of total cost of ownership that we feel are extremely important. And I think it's obviously very similar in the option space. When you look on the screens, you can tell at a glance, and you see when clients look at the screens, whether or not they're going to trade options on your product. I think, the high yield is a great example with HYG. We have it's one of the unique situations in the ETF market where there are two products that are of similar liquidity that provide similar exposure. But in the option space, HYG is it. And, it's very hard to convince a client to to use the other product when the screens look so deep in terms of liquidity.
I would say that there are a select few hedge fund type institutional clients that look at the options liquidity, and that drives their decision whether they're going to participate in a particular ETF. But that said, I believe that ETF options liquidity can help to tighten spreads in the ETFs themselves. I liken it to securities lending. As an ETF market maker, you look for a readily available borrow in a particular ETF because that can drive your spread tighter in that ETF. I look at the options that trade in a particular ETF as additive to the liquidity in the ETF itself. If you can lay off risk in the options market, you're more apt to provide a tight spread in that ETF itself.
So it looks like there are obstacles, but at the same time, it does seem like there are solutions as well. I think we have to drive to them, work together between issuers and ETF options market makers. And so I actually wanted to maybe change the structure around a little bit and have all of you ask each other questions. So maybe James, if you wanted to ask some questions to the ETF market makers, options market maker side on what you think they can do better or what you may want to know more about in depth, please feel free.
Sure, thanks. I'd love to take that opportunity. Just a question that comes up for us all the time, and I think I understand some elements of it, but I'd love to get a more detailed, kind of understanding of it. Is just what sort of things stand in the way of making, consistently tighter markets, kind of on screen in ETF options?
Sure. So. There are a couple different things that we look at there when we decide to put a tight liquid quote on the market, and that's what do we expect to trade on this quote, or are people going to be using our quote to price other things that are going to trade off screen or in other mechanisms? Because when we're sticking our quote out there, like we're exposing ourselves, we're sticking our neck out on. Across all of our options universe, 900,000 different options on 15, soon to be 16 exchanges. So it's very, we need to make sure that when we put our quote in the market and try to give transparent pricing into what we have to offer, that we will get to trade on that quote. So but in the current market structure, a lot of times we'll put a quote up there and we will not get to trade on that quote because trades will go up either in electronic price improvement auctions or off floor, or even in some cases OTC, as Stacey had mentioned. We're worried that really creates an adverse incentive for us to be able to continuously stick our neck out there with our electronic quotes when we don't even think we're going to get to trade on those. And we're worried that that's a bad cycle that will build on itself in terms of pulling the incentives for us. One other thing that I think about for a lot of the ETFs is information transparency as well. So anytime as a market maker that we need to think about, okay, what is the ETF issuer or the portfolio manager there going to do with a certain corporate action or a special dividend or in some extreme market event, that's more challenging for us to price into our options markets because we need to manage the uncertainty around what the issuer is going to do in that sense. So that's an ask that I have of the issuer side in terms of the more transparency and the more predictability we have into some of those, the tighter we can make our markets in many of those cases.
Stacey?
Right. No, I think LT brings up a good point that I'd like to kind of lobby back over to the issuer side, which is if we think about one of the biggest things about options, if you're an option owner, you're not entitled to dividends. We all know that, so we all know we need to price out what this dividend structure looks like. When there are changes to the dividend structure, and I'm not just saying it goes from 50 cents to 60 cents, something like that, yes, that's from a market making perspective, we don't love that, but that's just life. But when you change it where it's now shifted out of an expiration, better ways to understand the thought process there, I think, would be incredibly helpful. Because if for no other reason, if a retail investor or an institutional investor own the options and they lost to that, they're never trading those options again. Right? It's not just the market makers are upset. You have lost a client base because we couldn't anticipate how that was going to change. So my question back to you would be, are there ways that you can make it more transparent? Are there, even just understanding your timing structure, anything that can provide better transparency for the market makers, I think in return can help provide better liquidity? Do I speak for you with that? Yeah,
Oh, yeah.
I figured.
Well, it seems like there's a pretty consistent theme right there, so I'll lobby it back over to the issuer side and see if there's anything. I mean, I'm sure that this is something you haven't heard, you've heard before, but anything, let's say, that might give some insight into why it might be challenging and what you can do about it.
Yeah, specifically to dividends, essentially across different issuers and even intra-issuer, we see different methodologies with the way that the dividends are calculated. As an example, with Invesco PowerShares, on our calendar quarterlies, those dividends are calculated by the Bank of New York, our custodian. On the monthlies, which are more fixed income type products, we internally determine those distributions. And you have to know that, obviously there's going to be a little bit of variance at year end. Just because we have to pay out, as a 40 Act, we have to pay out 98% of the income that comes into the fund.
And I'll say certainly, over the years interacting with the options market, I think certainly I've gained a much greater understanding and appreciation for exactly that type of issue. But there are so many different ETF issuers out there, and while the market is pretty top heavy with the top 3 to 5 issuers, we're now up to about 80 issuers in the U.S. And I think there is an issue of understanding kind of what the unintended impact is going to be. Certainly, there are a lot of things that come up internally within our organization where, it certainly makes a lot of sense to make a change from one perspective, but then when we think about all the ramifications or the potential ramifications, we want to take a step back and be very careful about what we're doing and how we're doing it. One thing that we always focused on was having a lot of communication. When we do make a decision about what we're going to do with one of our funds, we try to communicate that as clearly as possible, as timely as possible out to the street. And then, the other thing is just being really careful. We recently did just change some X dates on a bunch of our funds to align with the new T2 settlement cycle. And I think you'll notice if you look at the new dividend calendar, the immediate change was made only on funds that don't have any open interest. So we do try to be sensitive to that, but certainly understand that it's a big issue. And I think whenever we're considering a major change, we'll actually go out and poll some of the market makers who are active on our ETFs, who we know also have a portion of the business that's trading the options as well, just to get a sense of if there are elements that we might not be thinking about that we should consider. But certainly, appreciate that issue. And I think just more transparency and communication would be a win for everyone.
And to add, from my side as well, working on the exchange, having contacts with the issuer side and the market making side as well is, I think that working together, ETFs are not just equities, they're not just derivatives, they're funds. They touch a lot of areas. And so from my perspective, I think it's important and a responsibility of mine to help grow the ETF industry and the ETF options industry is to keep the communication lines open, to keep the education open. We're in it together. The growth will benefit all of us, and so I put it on myself also to be a big proponent and a big voice in the industry as well. On that note, I actually wanted to see if we can take a question right now that just popped up, and the question is around what product types are competing for ETF options flow and diverting, let's say, market maker attention, and what are kind of the pros and cons of the competing products versus ETF options?
Yeah, I mean, index options are obviously one of the biggest competitors to ETF options. You look at the SPX versus the SPY versus IVV versus VOO. What are some of the advantages and disadvantages? I mean, the settlement is very, very different. The settlement timing is very, very different for the indices versus the ETF. If you want to actually have the deltas, i.e. through SPY or IVV or VOO, the ETF is the way to do it versus having to trade a basket with the index products where you're just going to get cash. So it depends a lot on what your preference is there, but there can be advantages to the indices over the ETFs for tax purposes, which I have to throw out there because compliance is out here somewhere. We are not a tax consultant, but there are different tax structures between the two as well. And obviously, ETFs will receive a dividend, assuming it is one that's paying a dividend versus the indices that it's kind of an implied dividend there. So there are some big differences between the two. One other product I would argue is really a competitive product, and it's not just on the market maker side, just to ETFs alone, is the mutual funds. They're kind of coming back. The ETFs existed and took a ton of AUM from mutual funds, but there is some shift going back to the mutual funds as they have cut costs. So I do think that is a competition, which then ultimately comes back into some of these index products.
Similarly, on the consistent theme of transparency of information, we like products that are trading on venue in transparent displayed markets, and so I contrast that to some of the products that end up trading OTC, which we're definitely not as excited about, and that's because we just don't think that we can offer quite as much there, and we prefer the on-screen liquidity, and that's one that we constantly see as a competing product to the ETF options.
Okay. So wanted to maybe take a chance right now, shift a little bit. You'd mentioned risk-weighted assets and capital costs. So maybe take a little bit of a deeper dive into this topic. Risk-weighted assets, RWA, has been mentioned before as a recurring theme, and it seems like the industry, both on the issuer side and the market maker side, is keen to this, and they see this as a significant headwind with supporting some of the less active products. So maybe, LT, can you start with a deeper dive into taking us down into why that matters?
Sure. So in a rising interest rate environment that we've now had over the past year, it's been capital's been more expensive for the market makers, and as we've talked about earlier in the conference, there's a relatively small number of firms that are clearing market makers, and risk-weighted assets is essentially a calculation that is very expensive in terms of how much capital market makers end up getting charged to clear our positions. Market makers have very complicated positions. We'll trade one strike with one client, another strike with a different client, and from our point of view, from a risk point of view, we're actually very risk neutral in that sense. Like where we go and we think we're flat. However, the capital charge that will get hit for some of those positions will be much larger than we think is really represented by the economic exposure of the structure of our position. And there are 900,000 different options, and we just don't get good risk offsets between those the way that RWA is calculated. And that is really, really challenging for market makers, even if you're a relatively small market maker, to be able to capitalize your position.
Stacey, anything to share?
No, I would agree. I mean, there's nothing I can say that hasn't been said, but it does impact most of the indices much more so than the ETFs. Now, it impacts your entire ETF portfolio because you add up, stocks that are $100, add up a bunch of them. But it is really a problem on the index level where you have a box and suddenly a box it's risky. You need to have all this capital. Well, I think we all know what a box does. It's not risky in terms of the way we think about it. And what LT said, we're market makers. Our job is to hedge out risk. Our job is to understand kind of where our risk is. So I would agree that this is certainly, it certainly does have implications in terms of liquidity that can be provided. And I thought the panel did a great job yesterday when they mentioned the timing of it, the timing of how that liquidity can be impacted. I thought was pretty interesting.
Okay, well, I think it was a great topic to reinforce, and maybe taking a little bit of a shift. I wanted to ask the ETF issuer space around, and some of this, RWA is related to regulations, and regulations are an important part of the industry, and I think that we all agree that smart regulation is important. And I want to talk about possibly, the idea that's been thrown around within the ETF community about separate rule sets for ETFs versus, let's say, other equities as well. Maybe, specifically for ETF options. Any thoughts on ETF options having their own rule set potentially, or at least maybe a greater conversation around just ETFs in general?
Yeah, certainly. I'll take that, and Grayson, if you'd like to chime in.
Yeah, go for it.
But yeah, this is something that I think has been up for discussion now for years. Certainly, since I joined the ETF industry almost 15 years ago, there were nuances to the product. ETFs are subject to the single stock trading rules, basic equity rules, and there are nuances that don't really make sense in the context of ETFs. And I know there have probably been a few situations that I've witnessed where there was a rule in terms of equity options that didn't necessarily fit for the ETF option. So I think some sort of either an entirely separate rule set or at least a different category of rules, maybe a Venn diagram of traditional equity rules and ETF rules with a large degree of overlap would make some sense, just to address those specific situations where, due to the structure of the ETF and the nature of the way it works, the rules aren't exactly a great fit.
Yeah, there's definitely a dichotomy between the way that ETF options trade and the way that single stock options trade, so I just echo that sentiment.
Okay, great. And so in my experience with trading ETFs is that oftentimes you can get a lot more ETF liquidity than what you see on screen. So ETF might, in a large cap equity exposure, could trade 100,000 shares a day, and if you want to trade 2 million shares in a day, you can get that liquidity and oftentimes very competitive with what you see in the screen markets, and sometimes even better than what you see on the screen markets. And so maybe, Stacey, I want to ask you a question around, so if let's say an investor really wants to trade options on a particular asset that they have, an ETF asset, what conversations can they have with someone like yourself on how can I get good liquidity and will it be there when I need it?
Right. I mean, this is a question I get asked often. This is my exposure. How can I put on a position? There are ways to put on a position. It may not be the exact position that you want every single time, but there are ways to put on a position, right? If you end up trading a put spread or a call spread versus outright puts, there's just more liquidity that you can get. It may not be the perfect hedge. So the conversation that I have with a lot of clients is, what is it that you're trying to hedge? What are you willing to give up if you can't get everything that you want? And some of that is you just have to trade a spread or you have to trade a risk reversal or there's something you're giving up in return. And that's fine. You just have to recognize that there are changes. Or it could be you're not going to have this perfect hedge, and this is when we get into SPY. Here's your basket. It's 90% correlated here. If we do have this crash here, historically this portfolio has been 100% correlated to SPY. So yes, it's not perfect for your 5% pullback, but it will be okay, most likely, historically speaking, on crashes. So it's a conversation of what can we do. And the other thing I would say, and this is really important, is SPX index options. There were periods where they were incredibly wide, but that wasn't the market that you actually got if you called a broker. Right? And yes, I am on the institutional sales side. I will fully admit that. But there are reasons to call a broker sometimes. The screen width that you see, they can be tighter. If you are overwriting an IVV or a VOO and you just want to overwrite it, we can hedge that out. LT can hedge that out in so many different ways. It's the S&P 500. So the screen liquidity, to the point earlier, may not be the true options liquidity. But to LT's point earlier, we can't sit there and have the quotes all day long waiting, hoping that you're going to come in, not knowing if we're actually going to participate on those tighter quotes. So there are a lot of different ways, I think, that you can have that conversation, just knowing that you may have to give up something, not have exactly what you want. But it can be done where you can get something that you're happy with.
So maybe another question from the audience. What partners can you rely on in the industry to help you, get better education, understand strategies, and who are the partners that you can work with within the industry to help you understand how ETF options will fit into your ETF portfolios? Maybe someone from the issuer side can help with that?
Yeah, definitely. So I just think that, and I hate to pitch my own desk, but the capital markets desks at the various issuers are great resources when it comes to ETF options. Essentially, all of the information regarding dividends, regarding NAV changes comes off of our desk first. And so if you want that information in a timely fashion, build relationships with your ETF capital markets partners.
Yeah, I'll just add that we're constantly working to understand the full offering that exists in the world, and certainly if someone or a group of others in the industry have a great offering already, we're probably going to be more likely to point clients to them rather than try to build it ourselves or try and answer that question when there's a better resource out there. So certainly, the OIC has been great in that regard for us, tremendous resource, and we're constantly, pointing clients who are interested in learning more about options to the OIC. And then even, again, we have this benefit of such a strong overlap between a lot of the market makers who are active in our ETFs, who we know very well, who have a very robust options trading business. So we're more than happy to, involve them in the conversation. At the end of the day, we just want to make sure that our clients have the best resources and the best education possible. And while we're more than happy to be kind of the first step in that conversation, the key for me is to be aware of all the resources that are out there and utilize them.
Well, we're running low on time, so maybe I want to give the ETF issuer, the market maker community, a chance to anything that maybe you want to share, a comment, a question to anyone on the panel as well, something that you wanted to address if you have a strong feeling about it.
I think we've covered a lot of the topics I think that are important, and I think that I've really appreciated the focus on education that we've had over the course of the week, and I think that's really, really important for us all to continue together, because what we're really looking forward to is growth overall in the industry. And we're talking about transparency, we're talking about capital, we're talking about market structure, and we're talking about education, and those are going to be the most important themes for us to hit to really continue to grow this industry, so that when we're here next year, volumes are even higher.
Okay. Even though that we're set up like Jerry Springer, we do view you as partners.
Okay, well, on that note, I think that it's a good place to end the panel. One thing I want to let the audience know as well is that people in our industries are very, very approachable. We like to educate, we like to have these conversations. We can have the conversation very general, we can take very deep dives. And so, feel free to reach out to our firms, reach out to myself at the exchange. We're more than happy to help make those connections, because we want the space to grow, and we can only make it grow. A big part of it is to have investor confidence in what we do and what we provide. So, thank you again for your time, and thank you to all the panelists. And I'll introduce Dan again.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.